It's important to look at giving a communication's content, context, and matter of presentation. Whether a particular communication from a firm or associated person to a customer reasonably could be viewed as a suggestion that the customer take action or refrain from taking action regarding a security or investment strategy. In addition, the more individually tailored the communication is to a particular customer or customers about a specific security or investment strategy, the more the communication will be viewed as a recommendation. Furthermore, a series of actions that may not constitute recommendations when viewed individually may amount to a recommendation when considered in aggregate. It also makes no difference whether the communication was initiated by a person or a computer software program, which actually happens more frequently today than historically. These guiding principles, together with the facts and circumstances of any particular case, inform the determination of whether the communication is a recommendation for purposes of FINRA's suitability rule. The rule explicitly applies to recommended investment strategies involving a security or securities. The word strategy is used within this rule very broadly. The suitability rule is triggered when a firm or associated person recommends a security or strategy, regardless of whether the recommendation results in a transaction. The term strategy includes, among other things, a broker's explicit recommendation to hold a security or securities. FINRA and the SEC have also held that associated persons who effect transactions on a customer's behalf without informing the customer have implicitly recommended those transactions, thereby triggering application of the suitability rule. For example, transactions in discretionary accounts are considered to be recommended transactions, thus the suitability rule applies. FINRA would not consider a broker-dealer's or a registered representative's recommendation that a customer generally invest in equity or in fixed income securities to be an investment strategy covered by this rule. However, an investment to customers, a recommendation made to customers to invest in more specific types of securities would be considered an investment strategy under this rule, such as high dividend companies or the dogs of the Dow, or in a particular market sector, regardless of whether the recommendation involved particular securities. This rule would also include within the term investment strategy recommendations to customers generally to use a bond ladder, day trading, liquefying home equity, or margin strategy involving securities, regardless of whether the recommendations involve specific securities. The suitability rule would apply in these situations. The suitability rule would apply to an investment strategy recommended by a broker-dealer or by a registered representative that includes both a security and a non-security investment. For example, suitability obligations apply to the recommendation of an investment strategy to use home equity to purchase securities or to liquidate securities to purchase an investment-related product that is not a security. The rule would apply if the associated person met with a customer during a quarterly or annual review and explicitly advises the customer not to sell any securities in or to make any changes to the account of the portfolio. The rule, however, does not cover an implicit recommendation to hold. The rule, for instance, would not apply where an associated person remains silent regarding or refrains from recommending the sale of securities held in an account. That is true regardless of whether the associated person previously recommended the purchase of securities. The customer purchased them without a recommendation, or the customer transferred them into the account from another firm where the same or different associated person handled the account. And last facts indicate that an associated person's failure to sell securities in a discretionary account was intended as an explicit recommendation to hold. FINRA does not view the associated person's inaction or silence in such circumstance as a recommendation to hold the securities for the purposes of the suitability rule. The suitability rule recognizes that customers may rely on firms and associated persons' investment expertise knowledge, and it is thus appropriate to hold firms and associated persons responsible for the recommendations that they make to customers, regardless of whether those recommendations result in transactions or generate transaction-based compensation. So the trigger, recommendation, we know that. The FINRA suitability rule does exempt certain categories of educational materials, as long as such material does not include, standing alone or in combination with other communications, a recommendation of a particular security or securities. Excluded communications include the following. So these are not considered to fall under the suitability rules so long as there's no recommendations being made. We're generally talking about educational material. So general financial and investment information, including basic investment concepts such as risk and return, diversification, dollar cost averaging, compound return, and tax-deferred investment. Communications discussing historic differences in the return of asset classes. So equities is an asset class, bonds an asset class, cash based upon standard market indices. Communications discussing the effects of inflation. Communications discussing the estimates of future retirement needs, so long as there's no recommendations being made. Assessment of a customer's investment profile, as long as there's no recommendations being made. Also excluded descriptive information about an employer-sponsored retirement or benefit plan, participation in the plan, the benefits of plan participation, and the investment options available under the plan. Excluded communications also include asset allocation models that are based upon generally accepted investment theory and are accompanied by a disclosure of all material facts and assumptions that may affect a reasonable investor's assessment of the asset allocation model or any report generated by such model. Also excluded are communications that are interactive investment materials that incorporate any of those we just discussed. For example, the suitability rule would cover a firm's recommendation that a customer purchase securities using margin, where the rule would not cover a firm's brochure that explains the risk and benefits of margin without suggesting that the customer take action. So if it's just a pamphlet describing how a margin account works, then the suitability rule does not apply. But if you're telling them to buy securities using margin, then of course the suitability rule would apply. There are three main suitability obligations under FINRA Rule 2111. So three main suitability obligations. The first one is a reasonable basis. So that goes way back. It's been around forever. Reasonable basis. The second obligation is that it is customer specific. Making a recommendation has to be for your customer. And the third obligation is that it is quantitative suitability. Quantitative. Reasonable basis suitability requires a broker to have a reasonable basis to believe, based upon reasonable diligence, that the recommendation is suitable for at least some investors. In general, reasonable diligence will vary depending upon, among other things, the complexity of and risks associated with the security or investment strategy and the firm's or associated person's familiarity with the security or investment strategy. A firm's or associated person's reasonable diligence must provide the firm or associated person with an understanding of the potential risks and rewards associated with the recommended security or strategy. Customer-specific suitability requires that a broker-dealer have a reasonable basis to believe that the recommendation is suitable for a particular customer based upon that customer's investment profile. So reasonable basis, customer-specific. A firm's approval of a product for sale does not necessarily mean that an associated person has complied with the reasonable basis obligation. If the firm has approved the product for sale, an individual associated person's lack of understanding of a recommended product or strategy could violate this obligation. So just because the firm has a new product doesn't mean the associated person really understands how it works. They have to understand how it works. A firm should educate its associated persons on the potential risks and rewards of products that the firm permits them to recommend. In general, an associated person may rely on a firm's fair and balanced explanation of the potential risks of a product. However, if an associated person remains uncertain about the potential risks and rewards of a product, or has reason to believe that the firm failed to address a particular issue, or has done so in an incomplete or inaccurate manner, then the associated person would need to engage in further inquiry before recommending the product. So we do sort of, as associated persons, have to rely on information provided us about the product by the firm. But if it's provided for a registered rep and they're still not sure about how it works, they better keep looking into it. You can't just say, I read everything given to me by my firm. That would not relieve them of the reasonable basis requirement. Customer specific, we talked about. Quantitative suitability. Quantitative suitability requires a broker who has actual or de facto control over a customer account to have a reasonable basis for believing that a series of recommended transactions, even if suitable when viewed in isolation, are not excessive or unsuitable for the customer when taken together in light of the customer's investment profile. So quantitative, how many transactions? Factors such as turnover rate, cost equity ratio, and use of in and out trading in a customer's account may provide a basis for finding that the activity at issue was, in fact, excessive, thus violating the quantitative suitability rule. FINRA's suitability rule makes it clear that a broker must have a firm understanding of both the customer and the product. It also makes it clear that a lack of understanding of either one violates the suitability rule. FINRA Rule 2111 prohibits a member or associated person from recommending a transaction or investment strategy involving a security or securities, or the continuing purchase of a security or securities, or use of an investment strategy involving a security or securities, unless the member or associated person has a reasonable basis to believe that the customer has a financial ability to meet such a commitment. So if you don't believe they can afford it, well then you shouldn't be recommending it. FINRA Rule 2111 provides an exemption to customer-specific suitability for recommendations to institutional customers under certain circumstances. This exemption's main focus is whether the broker has a reasonable basis to believe that the customer is capable of evaluating investment risks independently, both in general and with regard to particular transactions and investment strategies, and whether the institutional customer affirmatively acknowledges that it is exercising independent judgment. An institutional account, for the purposes of this suitability rule, includes an account of a bank, savings and loan association, an insurance company, a registered investment company, an investment advisor, or any other entity, whether a natural person, corporation, partnership, trust, or otherwise, with total assets of at least $50 million. So FINRA Rule 2111, the suitability rule, I would expect a handful of questions from this section of your score report to come from that. FINRA Rule 2150, customers, securities, or funds. No member firm or person associated with a member shall make improper use of a customer's securities or funds. That sounds like a fair rule. Every member in the conduct of its business shall adhere to the provisions of SEC Rule 15C 3-3 with respect to obtaining possession and control of securities and the maintenance of the appropriate cash reserves. We'll talk about that in another section. No member or person associated with a member shall guarantee a customer against loss in connection with any securities transaction or in any securities account of such customer. They can't guarantee you that you won't lose money. No member or associated person with a member shall share directly or indirectly in the profits or losses of any account of a customer carried by the member or any other member unless. So when is it okay that the associated person share in a customer's account? Such person associated with a member must obtain prior written authorization from the member employing the associated person. Such member or person associated with the member must obtain prior written authorization from the customer. So to share with your customer, you need permission of your firm, you need permission of your customer. Such member or person associated with the member must share in the profits or losses in any account of such customer, only in direct proportion to the financial contributions made to such account. In the real world, this is probably never going to happen. But when can a rep share in the account of a customer? When the firm has agreed to it, when the customer agrees to it, and the rep can only share in the proportion as to what they have invested. So if they've put in 20%, they can share in 20%. If they put in 60%, then they can share in 60%. However, exempt from the direct proportionate share limitation are accounts of the immediate family of such member or person associated with the member. For purposes of this rule, the term immediate family shall include parents, mother-in-law or father-in-law, husband or wife, children, or any relative to whose support the member or associated person otherwise contributes, directly or indirectly. When it relates to sharing in a customer's account, members shall preserve the required written authorizations. So written authorization from the member, written authorization from the customer for at least 6 years after the date the account is closed. I would know that. Records related to the written authorization required to share in that account must be kept for 6 years after the date the account is closed. FINRA Rule 3240, borrowing from or lending to customers. No person associated with a member firm in any registered capacity may borrow money from or lend money to any customer unless the member has written procedures allowing the borrowing and lending of money between registered persons and customers, and the lending or borrowing arrangement meets one of the following conditions. So, when can the registered rep borrow money or lend money to a customer? Number one, the firm must allow it, and one of these things must be true. The customer is a member of such person's immediate family. The customer is a financial institution regularly engaged in the business of providing credit, financing, or loans, or is another entity or person that regularly arranges or extends credit in the ordinary course of business. The customer and registered person are both registered persons of the same firm. The lending arrangement is based upon a personal relationship with the customer such that the loan would not have been solicited, offered, or given had the customer and the associated person not maintained a relationship outside of the broker-customer relationship, or the lending arrangement is based upon a business relationship outside of the broker-customer relationship. So generally speaking, registered reps cannot lend or borrow money from a customer to a customer. These are the exceptions. The registered person shall notify the member of the borrowing or lending arrangements prior to entering into such arrangements, and the member shall pre-approve in writing such arrangements. The registered person shall also notify the member, and the member shall pre-approve in writing any modifications to such arrangements, including any extension of the duration of such arrangements. Members shall preserve the written pre-approval for the borrowing or lending arrangement for at least 3 years after the date that the borrowing or lending arrangement has terminated, or for at least 3 years after the registered person's association with the member has terminated. With respect to the borrowing or lending arrangements with immediate family, a member's written procedures may indicate that the registered persons are not required to notify the member or receive member approval either prior to or subsequent to entering into such borrowing or lending arrangements. So it might be the case that the member firm says, hey, if you borrow money from your mom, please don't tell us. You don't have to tell us. If you lend money to your brother, you don't have to tell us. I would hope that that's what the firm would say, probably. With respect to the borrowing or lending arrangements with a financial institution, a member's written procedures may indicate that registered persons are not required to notify the member or receive member approval either prior to or subsequent to entering into such borrowing and lending arrangements, provided that the loan has been made on commercial terms and that the customer generally makes available to members of the public similarly situated as to need, purpose, and creditworthiness. In this rule, as far as borrowing or lending money to or from immediate family, it includes parents, grandparents, mother-in-law, father-in-law, husband, wife, brother, sister, brother-in-law, sister-in-law, son-in-law, daughter-in-law, children, grandchildren, cousins, aunts, uncles, niece, nephew, and any other person whom the registered person supports directly or indirectly to a material extent. So it's a much broader definition of immediate family than we saw as far as the definition of not needing to share in direct proportion with the customer's account. Much broader. NASD Rule 2510, discretionary accounts. No member shall affect with or for any customer's account in respect to which such member is vested with any discretionary power, any transactions of purchase or sale which are excessive in size or frequency in view of the financial resources and character of the account. No churning, especially be extra careful in discretionary accounts. Further, no member or registered representative shall exercise any discretionary power in a customer's account unless such customer has given prior written authorization to a stated individual and the account has been accepted by the member as evidenced in writing by the member. The member or a duly designated person, which is the principal, shall approve promptly in writing each discretionary order entered and shall review all discretionary accounts at frequent intervals in order to detect and prevent transactions which are excessive in size or frequency in view of the financial resources and character of the account. So first off, the firm has to accept the discretionary account in writing. Then the firm, granted the principal, shall approve promptly each discretionary order and shall review all discretionary accounts frequently. However, this rule shall not apply to discretion as to the price at which or the time when an order given by a customer for the purchase or sale of a definite amount of a specified security shall be executed, except that the authority to exercise time and price discretion will be considered to be in effect only until the end of the business day on which the order was entered. So if the client says they want 100 shares of Apple stock, they told you type, they told you quantity. They automatically give you discretion over timing and price. You will do it today. The order is good till the end of the day at whatever price the market will bear. Prohibited sales practices. Section 17 of the Securities Act of 1933 addresses fraudulent interstate transactions. by prohibiting the use of interstate commerce for the purpose of fraud or deceit. It is unlawful for any person in the offer or sale of any security to employ any device, scheme, or artifice to defraud, to obtain money or property by means of any untrue statement of a material fact or any omission to state a material fact necessary in order to make the statements made in light of the circumstances under which they were made not misleading, to engage in any transaction, practice, or course of business which would operate as a fraud or deceit upon the purchaser. That's something very similar to another section of the Act that we have previously discussed. Under the Securities Act of 1933, Section 13, lawsuits alleging fraud in the sale of a new issue must be brought within 1 year of discovery within 1 year of discovery or 3 years from the date of the actual transaction, whichever occurs first. So, of course, the Securities Act of 1933 prohibits fraud. So it says lawsuits related to fraud must be brought forth within 1 year of discovery or within 3 years from the date of the actual transaction, whichever occurs first. They love dates like that on this test. So if it was sold to the client today, 6 months later, the client realizes it was a fraudulent transaction. The client has 1 year from discovery to bring forth a lawsuit. Sold to the client today, 2.5 years later, the client realizes it was a fraudulent transaction. They still have 6 months left. So 1 year from discovery, 3 years from the date of the transaction, whichever occurs first. Section 23 of the 33 Act addresses unlawful representations. It states that neither the fact that the registration for a security has been filed or is in effect, nor the fact that a stop order is not in effect, shall be deemed to be a finding by the Commission that the registration statement is true and accurate on its face, or that it does not contain an untrue statement of fact or omit to state a material fact, or be held to mean that the Commission has in any way passed upon the merits of or given approval to such security. So this is like relieving the SEC of any liability. A very important part of the Securities Act of 1933. FINRA NASD conduct rules. FINRA Rule 5130 places restrictions on the purchase and sale of initial equity public offerings, or commonly called IPOs. FINRA Rule 5130 prohibits member firms from selling a new common stock issue to any account which restricted persons have a beneficial interest. A beneficial interest means any economic interest, such as the right to share in gains or losses. So restricted persons cannot buy new issues, new common stock IPOs. A restricted person means member firms or other broker-dealers. An IPO is supposed to be sold to the general public, not to broker-dealers. It also includes broker-dealer personnel, including officers, directors, associated persons, and employees. Restricted person also means agents or registered representatives or any member firm or any other broker-dealer that is engaged in the investment banking or securities business. It includes an immediate family member of a restricted person. If the restricted person materially supports the immediate family member, is employed by the member firm selling the new issue to the immediate family member, or has the ability to control the allocation of the new issue. For the purposes of this rule, immediate family is the smaller definition. So immediate family, so you can't buy an IPO for yourself or sell it to your immediate family is basically what this is saying. It includes your parents, including your parents-in-law. It includes your spouse, your brother, your sister, your brothers and sisters-in-law. It includes your children and your son and daughter-in-law, and any other individual to whom the person provides material support. It does not include aunts or uncles. Does not include cousins. So can you sell an IPO to your aunt? Yes. Can you sell this initial equity public offering to your uncle, your cousin? Yes, and yes. Materially support means directly or indirectly providing more than 25% of a person's income in the prior calendar year. So there's a definition for a term we've used a few times. Members of the immediate family living in the same household are deemed to be providing each other with material support. Federal Rule 2342 has to do with breakpoint sales. The sale of investment company shares in dollar amounts just below the point in which the sales charge is reduced on quantity transactions so as to share in the higher sales charge applicable to sales below the breakpoint is contrary to just and equitable principles of trade. For purposes of determining whether a sale in dollar amount just below a breakpoint was made in order to share in a higher sales charge, FINRA will consider the facts and circumstances, including, for example, whether a member has retained records that demonstrate that the trade was executed in accordance with a bona fide asset allocation program that the member offers to its customers, which is designed to meet their diversification needs and investment goals, and under which the member disclosed to its customers that they may not qualify for breakpoint reductions that are otherwise available. Front running is also prohibited. It shall be considered conduct inconsistent with just and equitable principles of trade for a member or a person associated with a member, for an account in which such member or person has an interest, for an account with respect to which such person or member exercises investment discretion, or for certain customer accounts to cause to be executed an order to buy or sell an option or security future when such member or person causing such order to be executed has material, non-public information concerning an imminent block transaction in the underlying security, or when a customer has been provided such material, non-public market information by the member or an associated person. A transaction involving 10,000 shares or more of an underlying security, or options or security futures covering such number of shares is generally deemed to be a block transaction. So no front running. Selling away is also prohibited. No person associated with a member shall participate in any manner in a private securities transaction outside the regular course or scope of a person's employment with a member, except in accordance with this rule. Prior to participating in any private securities transaction, an associated person shall provide written notice to the member with which he is associated, describing in detail the proposed transaction and the person's proposed role therein, and stating whether he will receive selling compensation. If the member firm approves a person's participation in a transaction, the transaction shall be recorded on the books and records of the member, and the member shall supervise the person's participation in the transaction as if the transaction were executed on behalf of the member. If the member disapproves of a person's participation, the person shall not participate in the transaction in any manner. So it is possible that your firm will say, no, you may not do that. Gift giving and receiving, we know the rule. No member or person associated with a member shall give anything of value in excess of $100 per individual per year to any person, principal, employee, agent, or representative of another person, where such payment is in relation to the business of the employer. So no more than $100 per person per year for gifts. Excessive trading, that's called churning, is of course prohibited. No member shall effect with or for any customer's account in respect to which such member or an associated person is vested with any discretionary power, any transaction of purchase or sales which are excessive in size or frequency in view of the financial resources and character of the account. Refund of sales charges. If any security issued by an open-end investment company is repurchased by the issuer or by the underwriter for the account of the issuer, or is tendered for redemption within 7 business days after the date of the transaction. So we've had a similar rule as far as this went with variable annuities as well. Tendered for redemption within 7 business days after the date of the transaction, the dealer or broker shall refund to the underwriter the full concession that was paid to the broker or dealer on the original sale. The underwriter shall forthwith pay to the issuer the underwriter's share of the sales charge on the original sale, and shall also pay to the issuer the refund which he received from the selling broker dealer when he receives it. The dealer or broker shall be notified by the underwriter of such repurchase or redemption within 10 days of the date on which the written request for redemption is delivered to the underwriter or issuer. If the original sale was made directly to the investor by the principal underwriter, the entire sales charge shall be paid to the issuer by the underwriter. So the key is if it's tendered for redemption within 7 business days, a refund of everything. Nobody gets paid when they got out within 7 days. Manipulative and deceptive devices are bad. Member firms, in the conduct of their business, shall observe high standards of commercial honor and just and equitable principles of trade. Under FINRA conduct rules, member firms may not engage in any of the following business practices. Forgery. Member firms may not engage in forgery or falsification of customer records. FINRA Rule 4530 requires that member firms report to FINRA promptly, no later than within 30 calendar days, after the firm knows or should have known that it or its associated person is the subject of any written customer complaint alleging theft or misappropriation of funds or securities or forgery. Texts and tweets are considered written format. So whether or not it's a text or a tweet or an email or a letter, all those are written format. Alleging theft or misappropriation. FINRA must be notified when? Promptly. That's the best answer. Within 30 calendar days is the way the rule is written. Promptly, no later than. So if you have a question about this, it won't include both. It might include promptly, or it might include within 30 calendar days. Switching, also prohibited. Member firms may not recommend that a customer buy shares in one fund and then encourage that the customer redeem those shares in order to buy shares in yet another fund within a short period of time. Short-term trading of mutual fund shares is not a good idea. Customers may incur additional expenses in the form of redemption fees and or sales charges, as well as have adverse tax consequences. Remember, even if a customer switches within the same family of funds, the IRS treats the transaction as a redemption and a repurchase for the purposes of any gains that would be owed. So it could result in a taxable gain. So no switching. Commingling of funds is also prohibited. Member firms may not commingle a customer's funds or securities with their own. No commingling. Member firms must have procedures in place to protect the misuse of non-public material information. Member firms must establish written supervisory procedures specifically prohibiting the use of material non-public information by all persons interested in, affiliated with, or in any way engaged in the securities-related activities of the broker-dealer. It's also prohibited under FINRA rules to sell a dividend. FINRA wants to ensure that registered reps can know that it's important to explain to their clients that when an investment company pays a dividend, the value of their shares will be reduced by the amount of the dividend as of the ex-dividend date. Attempting to influence a purchase of shares prior to the ex-dividend date is a violation of FINRA rules of conduct. The client may often be better off waiting until after the ex-dividend date to make the purchase, since dividends are subject to taxes and the amount of dividend is included in the price paid for the security. So no selling dividends. You have to explain how all that works to your client. If they still want to get the dividend, that's fine, but have them sign a letter saying that you explained it to them and they don't care, they're going to do it anyway. It's, of course, prohibited to guarantee against a loss. Broker-dealer firms may not guarantee that an investor will make a profit or guarantee against losses. That's a pretty heavy-duty chapter, and I know it includes a lot of reading by virtue of the way the law is written. It's law. I suppose it's probably why there's not more lawyers in the world, because it's so very boring. I hope I brought some insight to it, showed you some charts that you can practice. Remember, after this section, as in all of our sections, we have key facts. So read your sales practices key facts. Take the quiz that follows immediately thereafter. Have fun.